I know a lot of y'all always question and think, what's the point of using all those candlesticks? Well, candlesticks give you 4 times as much data than a regular line graph. First thing first, what makes candlestick charts better than a line graph chart? Well, first we're gonna put the line graph chart on and I'm gonna break this down. This is how bullish candles open and close within the stock market. They open at the bottom right here and they close at the top. The bottom wicks show the low, the top wicks show the high. The wicks represent rejection. What typically happens when a bearish engulfing pattern happens? Price go to hell. As we see on Venture Global, price went to hell. If we use the regular line graph, we can't see no bearish engulfing pattern. That's why candlesticks are more informative than a regular line graph. What is up, disciplined diamond hands? I'm glad to be back. I get to benefit humanity today. How do I get to benefit y'all? I get to teach y'all about the pros of investing. How you build wealth passively, how no physical labor is needed, how there's no cap on your salary as well. I appreciate you for subscribing because you forced me to learn how to be a better teacher. You help me to learn every day because if I teach every day, then I gotta learn every day and learn how to say it in a way that makes sense for you every day. And at the same time, I'm here for disciplined growth despite the channel stagnation. Even stocks have stagnation. Sometimes even the YouTube channel growth is stagnated sometimes, but we have disciplined diamond hands and we stay consistent, and we're gonna consistently grow this YouTube channel and grow our investing portfolio. I know a lot of y'all always question and think, what's the point of using all those candlesticks? Well, candlesticks give you 4 times as much data than a regular line graph. So you already ahead of the game by 4 times just by using candlesticks. This video, I'm gonna explain why candlesticks are important and how to use them to benefit yourself better than just using a line graph. Most beginners lose money because they don't understand the benefit of candlestick charts. So let me teach you in 10 minutes why candlestick charts are beneficial to every beginner to learn. First thing first, what makes candlestick charts better than a line graph chart? Well, first we're gonna put the line graph chart on and I'm gonna break this down. This is how bullish candles open and close within the stock market. They open at the bottom right here and they close at the top. How do you know? Well, price is going up, so you gotta open at the bottom and close at the top. As you can see for this bearish candle right here, bearish candles open at the top and close to the bottom because it's negative, it's going down in value. The bottom wicks show the low, the top wicks show the high. The wicks represent rejection. The longer the wick is, the more rejection there is within that time frame. The shorter the wick is, the less rejection it has. Sometimes it may not have no wick. No wick means no rejection. Just straight body, straight bullish momentum or bearish momentum. It may have a long wick at the bottom. It may be a pin bar. It may not have a wick at the top. But we're going to cover all of that today in this video. And those are the basic fundamentals of what a candlestick means. A candlestick mean and how it's broken down is if it's bullish, it opens at the bottom and closes at the top because price is going up. Or if it's bearish, it opens at the top and it closes at the bottom because price is going down. So now that we covered what are candlesticks and what are the diagrams of candlesticks and what do they mean, what are they open and close, what does the wicks mean, what is the high and the low of a candlestick, now that we understand that, I will go over how can we use that when we're looking at it on the charts to profit off of and to benefit off of. So no trading pattern or investing pattern is 100%. So a lot of the examples I show you will be examples, not saying all of them 100%, but all of them will help you and all of them will be easier for you to see after this video. Well, right here we got a doji at the top of the SPX. When the SPX made that all-time high on October 27th on the weekly time frame, look what the candlestick did. It had a long rejection at the top. That means it rejected all those buyers. And if we look up indecision candlesticks and we look at dojis online, we can see what dojis mean. Let's check it out. Check out this gravestone doji right here. This gravestone doji is the same doji that is seen right here. Rejection of buyers is going down. It made a long wick up. It meant buyers was buying it up, but sellers pushed it back down, rejecting all of those buyers. Check it out. Check out this picture of a doji right here. It's called a shooting star just because it fully closed without a bottom wick, but it's the same concept. Check out this, a long rejection at the top, price went down. Not saying it's 100% or that's what it could do more, but as you can tell, it did go down after it had a rejection of those buyers and it's starting to go back up. Will it break? We're gonna have to find out. Maybe it'll break before the new year. The next candlestick pattern we have is bullish engulfing. What is a bullish engulfing candlestick pattern? Check this out. The length of the bullish candle engulfs the previous red candle. That's what we see right here. Let me circle it for y'all so y'all can see it too. The length of the bullish candle engulfs the previous red candle. What typically happens after that happens? Well, on the chart, you see it went up, and that's what typically happens. But hey, nothing is 100%. But look at this picture as well. Once this engulfing pattern happened, an uptrend happened as well. So check this out. The same way we saw that big bullish engulfing pattern happen, it went back up. And then after we saw this gravestone doji happen, it went back down. So those are two ways that candlesticks provide a lot more info than a line graph, because a regular line graph, if you look at this circle right here, this line graph, it doesn't show you that. As well as right here, it doesn't show you that, or it doesn't show you what you could see with this candlestick right here. That is the reason why candlesticks are 4 times as much more important than line graphs, because they give you 4 times as much data. All right, check this out on Venture Global. Most candlestick patterns work best at key levels, and even then, they're not 100%. But they give you more data and more information than a regular line graph. So how can we use this pattern to our advantage? When we look at Venture Global and we look at this $18 range, this $18 resistance, we see a bearish engulfing pattern form. What is a bearish engulfing pattern? A bearish engulfing pattern is essentially when the length of a bearish candle engulfs the previous green candle. Check this out. What typically happens when a bearish engulfing pattern happens? Price go to hell. And as we see on Venture Global, price went to hell. If we use the regular line graph, we can't see no bearish engulfing pattern. That's why candlesticks are more informative than a regular line graph. Let's check out SPXL. On SPXL, we can see this gravestone doji form at the top. Price went down. A regular line graph ain't show that. A regular line graph didn't even show us the highs. The highs was $232.19. It doesn't even show you that. As well as this is another example where a line graph could give you less information and actually be harmful to you. All right, say me, I'm a dollar cost averager. I buy when things become undervalued. You see on this candlestick chart showed us that, okay, price went down to 115, price broke below this level. Price broke below this resistance. Price broke where I would buy it. I would definitely buy it here. A line graph didn't even show us it coming down to 116, what it came down to. So that's another disadvantage of the line graph. Yeah, it's more simpler to read, but it's going to be less profits as well if you go the simple route. Check this out. We have a bullish engulfing right here at this support level. Bullish engulfing line graph. We don't see bullish engulfing. We don't even see price go down to $87 with that line graph. But what does a bullish engulfing mean? Let's check it out. A bullish engulfing candle means the length of the bullish candle engulfs the previous red candle. What typically happens when that happens? Price typically goes up. And what typically happened once it did that bullish engulfing at this support area, it went back up. The size of the candles show you the momentum. The bigger the candlestick is, the more momentum that's held within it, the more strength that's also held within it. The bigger the body, the more conviction, the more buyers step in. The smaller the body, the more indecision. It's an equal balance between buyers and sellers. The bottom wick shows us that demand stepped in. Demand stepped in here. The buyers stepped in to push the price back up. The man steps in at that bottom wick. At the top wick, it shows rejection. Sellers stepped in after the buyers. Typically, when candles close past a key level, it means breakout. This is why a lot of breakout traders love to wait for candles to close. This is why you need patience as well, because depending on what time frame you're looking at the candle, you got to wait for it to close. You got to wait on the 5-minute time frame, or you got to wait on a 1-day time frame. Engulfing and pin bar patterns are my favorite and the most accurate in my opinion, because it's over 100 different candlestick patterns, and there's really no need to remember over 100 different candlestick patterns and use over 100 different indicators, because if you're always looking for an indicator, or you're always looking for a pattern, you will always be able to find the indicator in the pattern. But at the same time, indicators and patterns aren't 100%. So there's no point of always looking for something that's not 100%. Always combine your candle patterns with more context than just the reaction or just the pattern itself. Because just the pattern itself, especially if it's not at a key level, just the pattern itself, it won't give you enough information if you should buy or sell. So I always have like 4 to 5 different confluences, have some fundamental financial reasons as well, have some news that back you up as well, because chart patterns are irrelevant to news. You can think something breaking out, but terrible news will come out and sink the stock, or you'll think something falling, but great news come out or a merger come out and it rips up to the sky. So chart patterns or candlestick patterns alone won't help you or won't give you that 100% consistency that you're looking for. You need 4 to 5 convictions, but it will give you a lot more information and detail than just a regular line graph, because as we can see, a line graph doesn't show you, oh, price fell within this demand zone, or price had a bullish engulfing at this demand zone, or price had a rejection at this all-time high, or it won't even show you the highest level that price actually went, because the line graph is just of the candlestick charts. So that's why line graphs are trash and candlestick patterns and candlestick charts are way better. It gives you 4 times as much data. It helps you understand, oh, this is the demand level that it went at. Oh, this is the amount of rejection that happened. Oh, this is the amount of pressure that's built up into this one time frame. So appreciate y'all for watching. 200 subscribers before the New Year's, hopefully. If not, I don't really care. I'ma just stay consistent and stay disciplined, like my name say, Disciplined Diamond Hand. But I appreciate y'all a lot. Stay tuned, a lot more coming.